Welcome to the Explainer. The stock market is hitting all-time highs, Bitcoin is on a tear, and at the same time, some of the smartest investors out there are screaming bubble. So who's right? Are we all just partying on the edge of a cliff, or is there something else, something much deeper going on? Let's get into it.
Okay, so here's our game plan. We're going to start with those bubble warnings that have got everybody talking. Then we'll dive into the two big ones, Bitcoin and the S&P 500. After that, we'll zoom out and look at the actual money in our wallets. And finally, we'll uncover this huge liquidity wave that just might be the hidden force behind everything. You'll want to stick around because the takeaway at the end really pulls it all together.
All right, first up, the alarm bells. And they're being rung loud and clear by one of the most famous contrarian investors on the planet, Michael Burry. Now, if that name sounds familiar, it's because he's the guy who famously called the 2008 financial crisis. And right now, he thinks he sees another storm brewing.
And yeah, he's not exactly being subtle about it. He's pointing his finger directly at two of the market's hottest assets, Bitcoin and the broad S&P 500. But to really make his point, he's comparing them to one of the most infamous bubbles in all of history. So let's actually dig into that comparison.
So Burry is basically calling Bitcoin a flower. Specifically, he's comparing it to the Dutch tulip mania. Now, this isn't just some random insult. What he's really saying is that Bitcoin is a classic speculative mania, an asset whose price has become totally unhinged from any kind of real-world value. To see if he's got a point, we really need to understand what on earth happened with those tulips back in the 1600s. Okay, so check out how this whole thing unfolded. It starts at the top with the rich. A rare flower becomes a status symbol. Then that greed just trickles down to everybody else. I mean, this is the classic bubble pattern. But the key part here is the peak. People weren't even trading flowers anymore. They were trading paper contracts, futures, just betting on the price. The bulb itself became totally irrelevant. The only thing that mattered was believing that someone else, some greater fool, would pay more for it tomorrow. Sound at all familiar?
And this number, this just says it all. It really captures the sheer insanity. At its absolute peak, one single tulip bulb could cost you more than a house. We're talking 10 times what a skilled craftsman earned in an entire year. It was just pure madness. And of course, it all came crashing down. But this is where the debate gets really interesting. Because the defenders of Bitcoin say that this whole comparison, it's missing a much, much bigger bubble.
And this brings us to a really fascinating counterargument. You know, some people are saying that by obsessing over assets like Bitcoin, we're basically looking through the wrong end of the telescope.
What if the asset that's truly in a bubble isn't some fancy new digital currency, but the actual money that's printed by our own governments? Just look at this chart. This is the whole argument in one single picture. For centuries, the US dollar held its value pretty darn well. But look what happens right after 1971. It's not just a dip, it's a complete cliff dive. That $100 your great-grandparents might have saved has lost almost all of its power to buy things. So from this point of view, the money in our bank accounts is the asset that's been crashing for the last 50 years. So what was the big deal in 1971? Well, that's the year the US officially cut the dollar's tie to gold. Before that, every dollar was technically backed by a physical amount of gold sitting in a vault. After 1971, it became what we call a fiat currency, backed only by the government's promise. And that gave central banks the power to create money, well, out of thin air. So the argument goes that when you see people flocking to assets like Bitcoin, they aren't just gambling. They're looking for a lifeboat in an ocean of cash that's slowly losing its value.
All right, so what about the stock market? The S&P 500 is also smashing records. Is this rally built on a solid foundation, or is it just another bubble being inflated by that very same easy money?
This is where things get really confusing, because the signals are pointing in completely opposite directions. It's a real tug-of-war. In the bubble corner, you've got everyday people feeling worse about the economy than they have in years, and a huge amount of money is just being blindly poured into the market. But in the other corner, you have a legitimately game-changing technology like AI creating real value. Plus, global investors see the US as a safe haven and are pouring money in. So, which one of these forces is stronger?
Now, this whole idea of passive investing is a huge red flag for the bubble watchers. Just think about it for a second. More than half of all the money flowing into the S&P 500 isn't trying to pick individual winners. It's just buying everything all at once. It's like a rising tide that lifts all the boats, even the ones that are leaky and probably shouldn't be floating. It can push prices up simply because money is flowing in, not because the companies are actually doing better. So, with all these conflicting signals, what if there's some outside force at play, a hidden variable that could just override everything else we've been talking about? Well, there might be. And it all boils down to one word: liquidity. Or in simple terms, the sheer amount of cash just sloshing around the financial system. Okay, this might look a little complicated, but the idea behind it is actually pretty simple. Imagine the government has this giant savings account. Over the next few months, both the US Treasury and the Federal Reserve are basically planning to pump a huge amount of cash from that account directly into the banking system. It's like pouring rocket fuel into the market's engine. This money isn't coming from taxpayers, it's new liquidity created to keep the system humming, and that cash has to go somewhere. And we're not talking about a small amount. The estimate is around $300 billion. Now, in an economy worth trillions, that might not sound like a total game changer, but its effect is concentrated right on the financial markets. This injection acts like a safety net or a cushion under asset prices. It's this big wave of cash that could keep pushing everything higher, from Bitcoin to the S&P, no matter what the fundamentals say.
So we've looked at the bubble warnings, we've looked at the argument that our money is losing value, and now we have this powerful wave of cash coming in. What does it all mean? What's the real story here?
And here it is, the key takeaway. The market right now isn't a simple story of bubble versus fundamentals. It's more like a three-way battle. You've got real speculative craziness, butting heads with a totally rational fear of our money losing value, and all of it is floating on top of this massive artificial wave of central bank liquidity. And for the time being, it really seems like that liquidity wave is the most powerful force of all.
And that right there leads us to the one question that should probably be on every single investor's mind. Right now, the story is all about liquidity, but this support system won't last forever. So the biggest risk might not be some bubble popping tomorrow, but what happens the moment the central banks finally decide to turn off the taps. What happens then? Thanks for joining this explainer.